guys, welcome to another episode of Technical Analysis. Today we are going to learn about reward to risk ratio, and this is one of the most important topic that you will come across in technical analysis. Every trade of yours should go through this check always to make sure that you increase your profits and decrease your losses. So how do you take out the reward to risk ratio? Let's consider one example. Suppose you find a stock where you find the entry at 55.75 rupees. You consider your stop loss to be at 53.55, your target to be 57.2. So you take out risk by subtracting stop loss from entry. So entry minus stop loss, that is 55.75 minus 53.55 would give you 2.2 here, and you take out your reward, that is target minus entry. So target is 57.2 minus entry 55.75, you get 1.45. Now you divide 1.45 with 2.2. So 1.45 divided by 2.2 would give you 0.65, and that would be your RRR, or your risk to reward ratio. So that basically means that you are taking more risk and you are getting less reward. That is, if the stock goes according to your preference, you'll just make 1.45 rupees profit, but it does not move in your direction, then you will make a loss of 2.2 rupees. So this is not a good trade. You should avoid such a trade. Let's take another example. Suppose you get an entry at 107, your stop loss is 102, your target is 114, your risk would be 5, as in 107 minus 102, and your reward would be 114 minus 107, that is 7 rupees. So your risk to reward ratio here would be 7 divided by 5, that is 1.4. So that means if you take this trade and if the trade goes in your direction, then you will have a good reward. If it does not go in your direction, then you will have a loss of 5 rupees, which is still lesser than the reward. So any trade that has a reward to risk ratio more than 1 is supposed to be a good trade. Professional traders usually keep that above 1.5. So let's take an example. We'll go to trading view. Let's say I bull housing finance. Let's try to find a pattern in this chart, and then we'll find out the risk to reward ratio. But do not worry, you do not really have to take a pen and paper and find out the risk to reward ratio. You can do without that too. Okay, this is the hourly chart of iBull Housing Finance. We see a hammer pattern forming here. So if you can recall, when a hammer pattern is formed, you take an entry when there is a closing above the high of the hammer pattern, that is 177, more than 177 points, so 176.10. If there is any closing above that, we take a trade. So the next candle was 176.5 approximately. So this is a proper entry, and the stop loss would be here because that is the low of the hammer, so that it would be 173.5, and your target would be your first immediate resistance, that would be around here, it's 179 to 180, around the 180 mark. So you click this, you click here, and you select long position because we are going for a buy position, and you set it over here. So we will enter the trade at this point. We'll set the stop loss till here, and we'll set the first target somewhere over here. So if you see, the risk to reward ratio here is 1.17, which is more than 1, which is good, but you see it broke the resistance here. The first that was actually a support of this, which became a resistance because of the theory we learned, support becomes resistance. It broke that, and the next resistance would be here, so we can go up till here. So this seems to be a very good trade. You can definitely go ahead with this trade. So that's how you take out risk to reward ratio. Now coming back, we know everything about technical analysis, so let me just give you a rule sheet, so that if you follow that rule sheet with your every trade, you will have trades that go into your favor 90% of the time. So the first rule would be forms a recognizable candlestick pattern. The second rule would be the support and resistance should confirm your trade. The third rule would be volume should confirm your trade. That is, the volume should be above average, above the last 10-day average. Fourth, look for price patterns. If there is a price pattern with all these things happening, then when you have all these four in place, then look for indicators if the indicators are also giving you a positive signal. And finally, your reward to risk ratio should be more than 1. If you have all the 6 rules in place, definitely go ahead with the trade, and there is a very good chance that your trade would move in your direction. So with this, we will come to the end of this video and also the end of technical analysis. You can start practicing whatever you have learned till now. You can begin your trading journey from here. From the next video onwards, we'll start with fundamental analysis, where we will learn to pick up value stocks for the long term instead of just trading in the short term. With this, I'll wish you all the best. Take care, keep watching. Cheers, bye.